Ajay Srivastava, the CEO at Dimensions Consulting as well, joins in. Ajay, we know what Akash Bhansali is buying, but we want to know what Ajay Srivastava is putting his finger on.
Well, that's interesting because I think this is the both the problem and the good part of the market is that people follow in hordes at any valuation thereafter. And as you saw what happened in JP Associate, you can come to grief in a number of cases. So there's a caveat there that not everything everybody buys goes for a sixer, and therefore you might get out as well. But I think what we are buying, I think we are sticking on to what our existing holding is. I don't think we've added too much to portfolios. By and large in the last week, we still believe that it's time to kind of a little bit, just keep what you have. Very convinced about the stories that we got on our portfolio. We are not expanding the portfolio at this point of time. You know, let's put it this way. What was a smooth ride is now we're putting our seatbelts on, expecting a little more bumpiness around. So might as well be in the seat with the seatbelt on rather than working all over the plane with the new portfolio. I think that's the mantra, and you've got to be very convinced of the stories you're buying today.
Yeah,
because I think you guys are already talking, the narrative has been so much complex.
Ajay, would you agree with my assessment that 3 weeks ago there was markets were blind to economic reality? There was hope, there was hype, and there was a belief that nothing can go wrong or nothing could go wrong for India. But the narrative has changed now. The fact that Prime Minister himself had to come out and defend the economic growth, that just tells you that some degree of reality check has kicked in. So if expectations, let's say, were running very high, now expectations from earnings are reasonable and they are more tempered.
I think what you're saying is correct. But by and large, what you're saying is correct. And I think the narrative was, unfortunately, if you look at last 3 months, it was not the institutional money which was going into play, or not HNI's money going into play. Unfortunately, it was the retail public pouring in money into mutual fund, which was causing the liquidity overhang, and which is going to be the curse of this market, because if this narrative continues and the performance does not become, the economy does not take a major change to fly up again back to 7.5% or 8% thereabouts, you would see a dramatic change in the approach of the retail investors to the market. You would see SIPs slowing down, you'll see fresh investments slowing down, and that is what worries me today, is not the earnings. Earnings, we know what kind of companies will give what kind of earnings. By and large, we are reasonably sure of what we're talking about. What we are worried about is that will this whole scenario as it emerges, how much impact will it have on the psyche of the retail investor to start taking the liquidity off the table for mutual fund? Let's be honest, mutual funds kept the market alive in the last 2 months. There's the only reason why market is at 9,900 and not at 9,200 or 9,000 at all. That's the only reason. And that liquidity, I think, is an important question mark as you go forward in the next quarter, because if things don't turn out, and that's why this quarter, I think what you said is dramatically important for the market, not for the reason that earnings, every quarter we'll have earnings and changes, but for the way it affects the psyche of the people. For the first time, the psyche is affected. Now, we may say we are pessimist or optimist or negatives or positive. Right. The fact is that what you said, quote unquote, reality check is now seeping into the market at the retail level, which impacts. That's the worry part, not really the earnings.
Okay, Ajay, the construct of the market is that consumers and by and large are expensive, whether it is autos, staples or discretionary. You have to bet on the economic turnaround. But if I look at the so-called proxy economic plays, whether it's ICICI Bank, a name like HCC, NCC, an odd BHEL, I don't think markets are aligning with what smart guys are trying to do or what smart portfolios are trying to, indicate. I'm sure in your portfolios also, you must have taken some names which are indirectly beneficiaries of economic recovery. But markets continue to chase consumer names. Markets continue to believe that economic recovery is around the corner, but these stocks are not getting recognized. How crazy is that?
No, it's not crazy. It's a fact. No, the question you asked me, what is my portfolio mix strategy? The portfolio mix strategy in our case has been simply that we are going for stocks which are in fact counter-cyclical to the economic recovery. The point is that you'll have a situation where lots of companies are going to do extremely well in a scenario where the economy will dawdle around. And the reason we have shared number of times is that the market share is now moving dramatically away from a large swath of small MSME, etc., to the big corporation. And for example, we have a holding, pretty big holding in one company called BATA, and we've been increasing the holding. The point is that this consolidation play which is taking place is going to give enormous profits to these companies, even if the economy dawdles at 5%. So the play now is not, in my view, and I could be wrong totally, the play now is do not worry about players which are linked to the economy, because they're not going anywhere in a hurry. You got to be in the stocks which are counter-cyclical. Even if the economy dawdles around, these players will perform and do extremely well. That's where the money should be lying, And number two, go for the breakout players. Don't worry about the cheap bargain players, etc. This is not a market for that. A dawdling economy or a slowing economy does not reward marginal performers. You need to jettison that portfolio at this point of time. You either have two parts of the portfolio: breakout cases who are reaching all-time highs, focus on them. Or number two is serious value buyers, like we have I'll quote it, my holding in GMR, where the airport business is going to become so valuable over time in a monopoly situation in the country that the company will acquire value. Debt will eventually go down over 2-3 years. It might not break out tomorrow morning, or it may break out this thing. Number two, defense stories. I think you're going to see a lot of defense contracts coming out. The government is under pressure. They will start releasing contracts. So be counter-cyclical to economic recovery, because if you're basing your portfolio on economic recovery, I don't think you're going to make it at all anywhere in a hurry, because economic recovery will take time. This, the curve is going this way. First, it has to stall, then it has to move up. Now, that's a humongous effort. In 18 months with elections are due, and maybe elections are plus minus 3, 4, 5% the months, they might prepone the elections for whatever reason they are. So, you're not looking at a scenario where there's too much time with the government now left to do such a dramatic measure to change the economic agenda so radically. Okay, yeah, you might get some very good news today. So don't, in our view, do not bet on companies' economic recovery. That's why we don't believe ICICI Bank equivalent will do any great, apart from governance reasons which we don't like the bank. We'll leave that aside. So my belief, do not bet on companies linked to economic recovery. Number 2, 3 scenario is build on natural resource companies. They are dirt cheap in this country. Where in the world do you get the biggest producers of aluminum, the biggest producers of iron ore at 1.5 times book value with zero debt? You'll never get it again. Yeah, they will take their own time to perform, but buy them because they will be sold eventually. So I think concept is simple. Breakout cases, very good buys because they will get market share, they will do well. Number 2 is serious value plays on the underside of the market with a leverage, and now getting onto the leverage game, things like GMR that we quoted, etc. Right? And the third is defense plays, and the last is a longer term bet to the resource companies. We are not betting on economic recovery cases because that's I don't know, it may play out, may not play out, but these ones will play out eventually.
As with some of the consumption names, and quite literally so, Ajay, if you were to pick up a bunch of movers from the year gone by, it's all consumption. You highlighted BATA, there's Avenue Supermarts. Today, you've got all and every retail stock buzzing out because of the Hypercity Future Retail deal. Where does consumption actually pan out in your portfolio, aside of BATA, which you already talked about?
See, retail is there in our portfolio, but Avenue DMart is not in our portfolio at this point of time. We think it's too expensive, but that is our view. I don't think market shares that view at this point of time. But I think the play is very simple in retail, and I think this is which is going around in the surface, that multi-brand retail is around the corner. They will encourage people to come and buy out companies. I think that's what is really the play going on. It's already consolidation plays are going on at this point of time. You saw the Hypercity that you mentioned, buyout by Biani Retail. There are 4 or 5 players left in this market, or 3 players in fact left in the market. If Shoppers Stop goes out, you got Lifestyle, which is a privately held company which is left there. Then it is Biani's company which is left there, and nobody else after thereafter. The very few. West Side is again it's an apparel-based company. It's not a generally product-based company. So you are looking at a scenario where there is a scarcity space, and if this government policy, which seems to be that they will change it or tweak it or do something about it, comes, these will be the biggest beneficiaries. That's one. Number 2, let's be honest, what we discussed, the same theme as what we discussed BATA. As the shopping will move away from the MSME, the shopkeepers, etc., who can't survive, can't have the onslaught of discounts, who will be closing their shops, the shopping will move to the organized retail. I think that's the biggest play here. That's why I said these are breakout cases. These are not the cases which are restructuring cases. Therefore, consumption story is good, but only at the upper end of the cycle. Consolidation plays not at the lower end of the cycle. But there's not much to buy, apart from Biani Retail. Where do you go buy? Aditya Birla Fashion is only the company. What else do you buy in this market? We don't have retail stocks.
Yeah, we don't. But we have many retail options. So as consumers, we are happy with that. But Ajay, good speaking with you as always. And we hope we are going to have another interaction with you somewhere around Diwali as well.